Okay, folks, welcome back. Week ending June 14, 2019. General commentary, dollar index, euro dollar, pound dollar, and this week's lesson is going to be price action lesson on where do high probability fair value gaps form. So moving into our economic calendar for the week to come, big landmine field in front of us. We have ECB Draghi speaking on Monday at 1 p.m. Then again, speaking at 4 a.m., Draghi is speaking. We have a high impact GBP, Carney speaking at 10 a.m. Medium impact for Euro in the 5 o'clock hour towards the end of London Open. And building permits, medium impact for dollar, 8:30 a.m. on Tuesday. On Wednesday, we have high impact CPI for GBP, London Open. And again, on Wednesday, ECB, Draghi is speaking, high impact for the Euro. Then later at 2 p.m., we have FOMC for the dollar index and federal funds rate, FOMC statement. And on Thursday, we have high impact London Open GBP retail sales. And OPEC is tentative for Thursday. 7 a.m., New York Open, official bank rate votes and monetary policy summary for GBP, high impact, official bank rate, and asset purchase facility. 8:30 a.m., Philly Fed manufacturing index, and at 4 p.m., Carney speaks, high impact for GBP. On Friday, we have high impact French flash service PMI, London Open for the Euro, and at 8:30 a.m. New York, we have GBP. Public sector, I forgot to mention that, for pound towards the end of London Open for Friday. And at noon, we have FOMC member speaking. So, you already know what I'm going to say. It's going to be a very volatile week for Euro and pound. The uncertainty we'll talk about when we get into the charts, but nonetheless, let's move forward. All right, so last week, here's the dollar index. It's a daily chart. We had a nice run back up into the SIBI here. So we have buy-side liquidity has been purged here. The closure at this candle is low. That's what I'm watching to see what sensitivity, if at all. If we trade above this low on a closing basis, buy-side liquidity will be the next draw for dollar. Notice we are just hanging around in this range right now. It's nothing in terms of trending. We haven't really made a trending environment yet, or I should say we have not obtained a trending profile yet. It's unclear to me what we'll still aim for, but the level I'm watching for this week is basically that 97.65 level. I don't think it needs to go to 97.80. Obviously, it can do so, but I don't think that if we close above that level that's indicated here on the daily, that's going to be indication that we're selling off. I think we'll probably reach up in there and sweep that buy-side liquidity pool at 98.23. So again, very difficult conditions at the moment, and we have to adapt to that. Moving into the 60-minute chart for dollar index, you can see we had a Sunday opening gap here. Price comes back down, closes the gap in beautifully, and then price rallies up, creates fair value gap in here and in here. All it needs to do is trade to this low. It does so here, and rallies up, and needs to trade below this low. It does so, and rallies higher. We have a buy-side liquidity pool resting in here. No real fair value gaps to mention in this area, so it'll just be how are we going to trade up into that 97.65 level. The bearish order block, basically the mean threshold, just above that is what I'm allowing for. But if we close above that, it may be indicative of a little bit more upside to reach for that daily buy-side liquidity pool. In the 15-minute chart, you can see, again, greater detail. Sunday gap opening, closure, fair value gap, trades below that low, does so here, And fair value gap also reduced down to this price point here, and the price rallies higher. Euro on the daily, we had mentioned we swept the buy side liquidity pool here. We've done several attempts to try to make a rally higher. Couldn't do so, gave up the ghost and traded lower. Now, if we get this higher dollar scenario, okay, say Draghi really talks Euro down to run the sell side liquidity pool, it would have to do so in convincing fashion below, on a closing basis, the fair value gap. It's shown here. If we rally back up to this down close candle here, I'm viewing that as a bearish breaker. Now, if we trade down through, close the fair value gap, and rally back above the open on this down close candle with a breaker, then we'll be looking for another run to the buy side liquidity pool here. So again, it's a 50-50 shot, so it's not high probability. That's how I define it. If it's not one-sided, where I can clearly see where we're going to be reaching for, it's not high probability. So it may not be what you want to hear, but it's what you need to hear. All right, so here's the hourly chart for Euro. Again, the buy side liquidity pool noted above at 113.50 or so, and the fair value gap right in here, and the breaker. So we have this wick, and nothing really in terms of imbalance over here that would be below the wick. So it may be a deeper run in the cards for Euro, but I have to see what we do relative to that breaker on the daily. You can see the fair value gap here. Needs to trade above this candle's high. It does so. Trades off. Same thing here. Trades above it, above this candle's high, and then sells off. Really handsome price action for Euro. On the 15-minute time frame, again, you can see that fair value gap and the subsequent returns back into it. And you have a smaller one in here. You find that on your 15-minute chart. And here's that fair value gap from the hourly, where it just creates one single candle above the necessary high, and in distribution again. It's interesting that we didn't take it below this wick low, but we have consolidated, so we'll see what we do on Sunday. I think that they'll probably want to sweep below that and try to press a little bit lower. The rejection, should we get below this low and if it trades back higher, again, takes us back to that buy side liquidity pool. So as I mentioned in Wednesday's video, I was divided in my thoughts about Euro and cable and the dollar. So the expression that's used, when in doubt, stay out, that's pretty much what I did for last week. And more or less it goes along for the same thing for this week with the economic calendar as it is. Too many uncertainties. All right, so cable on the daily chart. I mentioned that we could probably trade back up into that low here if we saw a slide on the dollar. Didn't see that, obviously. So we didn't get back to this low. Buy side liquidity rests above the fair value gap here, and then that old low. And I mentioned that we could potentially trade sideways in here if we didn't go higher. So kind of like think about it in this same area here. We're seeing that here. Now the sell side liquidity pool resting below this daily low, that's going to be interesting to see what they do if we trade below that this week. So again, it's a matter of a pair like Euro. It's heavy. It looks like it wants to go lower. Does it want to go down below 124.30? That I don't know. But with all of the speaking it's scheduled to take place this week, anything can happen. And I don't like to trade with uncertainty. I want to have it like in my favor, slanted heavily on one side. That's what makes it a low resistance liquidity run. That's like my forte for trading. All right, so the hourly chart on cable, you can see that fair value gap, really nice consequent encroachment, and sells off. Again, the next draw on liquidity is here. Small little fair value gap around that 126.15 level, so watch that if we do get any kind of upside. That might be a catalyst for a further downside. Again, I'm just tossing that out there. I'm not going to be trading cable or euro this week. And 15-minute chart, you can see a nice consequent encroachment, a fair value gap there. Small little fair value gap in here. And we went just above it more than would be necessary. But you always use the swing high to the left of that, and it will give you your point of stop placement. Again, the fair value gap is just the entry. It's not your be-all, end-all where the stop goes. It's relative to the swing high or swing low prior to its formation. All right, so we have really an unclear, or at least I feel unsure, if you will, about what to expect for euro and cable. Now, this goes along with pretty much what I had last week, and for some of you that may be a little unsettling, especially the new folks. But I want you to go back and watch Wednesday's video, because the Wednesday video kind of like highlights when I leave my pet pairs. Fiber and cable. Okay, euro dollar is fiber and cable is GBP USD. Those two are my favorites. Now, I look for setups every single week with those two. But there's going to be times, as you've seen recently, this week and last, where I just can't get a confident read on it. So then and only then do I like to look outside those two pairs to go and look at the loonie, which is dollar CAD, or the Aussie dollar. So with Aussie, and it takes us right into the lesson of this week. Aussie dollar is a pair that I don't like to do too much with unless there's simply nothing for me to see and trust in euro and pound. So if I don't have a confident read on it, and I mentioned this last week, it's not a weakness. It's an invitation to look at other pairs. On Wednesday, I mentioned that I was divided on both euro and pound. I wasn't certain which direction because of the dollar index. But I did mention on Wednesday that I felt confident that the Aussie dollar would run its daily equal low, so its sell side liquidity pool. And I'd be watching that, looking for scenarios and setups in that pair. So I guess the language, if you go back and listen to what I was saying, I didn't make too much of a point of it, and I guess it's a failure on my part at the time, but I get questioned a lot, why do I only trade euro and cable? Because I like them and they're easy to see and they're closely correlated. But sometimes it's not easy for me to read those, so I have to look at other pairs or do nothing. So I tossed out Aussie dollar last Wednesday or just this past Wednesday, to highlight, number one, a low resistance liquidity run that was forming on the daily chart. Also, to provide you the framework, because I gave one last challenge for this week on Twitter to find 60 pips. So I kind of like pointed, again, where I point, you shoot, okay? And I want to use the Aussie dollar as a teaching environment for this week's lesson. Obviously, the lesson is going to be where do high probability fair value gaps form. Now, there's fair value gaps forming on all time frames, but what differentiates it from a high probability and a just simple common gap? And that's what I'm going to cover now. When we look at price action like this is a simple 15-minute chart. It could be a little confusing, may even cause some bewilderment for a new trader or a new student within the mentorship. There's a lot of things in this chart, but I want to keep the focus on just the fair value gap and what differentiates a common gap and a fair value gap. Before I get into it, again, a fair value gap is an imbalance on a very short-term basis between three candles. Okay, one single pass candle between the candle to the left and the candle to the right of it. Now, it's important to know that just simply because it creates a fair value gap doesn't mean that you hold out forever and look just for that to fill. It doesn't have to fill. which is the reason why I taught you the institutional order flow entry drill. It requires just the shortest time frame of a violation or entry back into the gap. The gap can remain open, or it can be filled partially. It could be half filled, 3/4 filled, or it can go slightly beyond the gap closure. None of those invalidate a fair value gap. It's just that the fair value gap is that signature that we look for an imbalance on a short term. And IPTA will want to go back and rebalance that price point. Now in 2010, when I began teaching exclusively Forex online, the first lesson I taught the populace at large was to focus on daily highs and lows. Now, the inside track was that I was doing that as a social experiment. I wanted to see if people would pick up on what I picked up on, and this is one of those signatures. Now, there's a lot to say about daily highs and lows, but I'm going to teach you how they're important as it relates to fair value gaps. So if we look at a chart and we start adding some details, okay, adding lipstick, if you will, you want to note the daily highs and lows. Now, it's important to note these levels because you should have them not only in your notes before you even sit down and look at the charts, but you should have them in your charts themselves, because those levels are going to be very influential in the future, especially looking back the last 3 days. So, remember when I first started teaching on baby pips, I said that I look at the last 3 days. Okay, so why is that important? Well, swing highs and swing lows form, but also the fair value gap. Think, these things I've been using for 2 decades, and I want you to understand that I left breadcrumbs all along when I was doing the free tutorials. But the details that are lacking and the gaps that I placed in that content were there for a personal challenge. It wasn't my intention to create a mentorship, and I didn't want to go back into all this again, but out of necessity to preserve my own intellectual property, and also just to be able to challenge individuals that are doing what they shouldn't be doing with my content, which is either repackaging or selling it outright or sharing. I created it in a corporate entity, so it wasn't my intention, but it is what it is. That's what we ended up going into. So, but the last 3 days is important because of pivot swing highs and pivot swing lows, and the formation of fair value gaps, because a fair value gap is defined by 3 candles. One single pass candle in the middle, where there is no back and forth delivery of price. It's usually one-sided, and you look at the candle to the left of it and the candle to the right of it, and that defines your fair value gap. That phenomenon is fractal, so it exists on all time frames. The element of the daily high and the low is very important because that's where a lot of the interbank dealing is going to be utilized. So if you look at this chart, I have the daily highs and lows denoted on 3 of the days. Friday, I don't need to have it because it's Friday and the end of the week. I noticed last Wednesday that the Aussie dollar was looking toppy. Okay, so I kept it to myself, obviously, but I did mention on Wednesday, this past Wednesday, that it would most likely want to reach for its sell-side liquidity pool on a daily chart. So it gave you the framework or context to operate in for practicing. So we had a draw on liquidity, which is 68.65, okay, or liquidity below that level. So you have to have the directional bias on the market. That's what makes a high probability fair value gap, number one. You have to know what it's reaching for. Now, let's backpedal for a second. Do I know what euro dollar and British pound and the dollar index are going to presently reach for near term? No, I don't. Now, as a new trader here or new student, that may be unsettling, okay? But it's nothing to be worried about because you're going to encounter that yourself. And you want to be honest with yourself. You want to accept the fact that there's going to be times when specific markets, not all markets, specific markets, and it may be the pairs that you watch or asset classes that you watch, and they may be just unclear to you, okay, or you second guess yourself. There's nothing wrong with that, okay. It's not an evidence that you don't know what you're doing or you're not as good as you think you should be. It's maturity. That's what you need to understand, because it's these moments that, if I look back over the last 27 years, come this November, and think about that, November 5th, it'll be 27 years I've been doing this stuff. And I can tell you, all of the pain, all of the losses came when I knew in my gut that there was really nothing I could trust on the chart. I got some extra time. Let me just throw some money in the marketplace and see what happens. Well, you know what happened. I lost. And then that single loss was parlayed into a string of losses. And then all of a sudden the account was dusted. So I'm telling you that when I'm unsure, I'm okay with telling you I'm unsure, because I know those painful lessons that came by way of all of those losses. I don't need to relive all that again. And I'm okay with telling you I don't know something. So if I'm telling you as your instructor, there's times when I am comfortable saying I don't know, so therefore I have to look at other assets or other pairs. That's why I kind of like prodded you to look at Aussie dollar, because even though I want to keep our focus limited to euro dollar and pound dollar, there are times when it's logically in your best interest to look outside those two pairs. Then and only then will I like to do that, because I want you to understand and trust you can have one or two pet markets and it'll suffice. It'll give you everything you would need for a trading career. But you have to be somewhat flexible, okay, in terms of if your pairs or your markets aren't speaking to you, okay, or you can't determine, get a good read on what the market's suggesting or implying to you in your favorite markets, then you have to do one of two things. You have to do nothing, which I admit is very, very hard for someone that's new, because you feel like it's counterproductive. You should be doing something. But when you mature, doing nothing when it's unsure is actually the best thing to do. That's wisdom. So it took a lot of money losing it, okay, and a lot of patience developed because of all that, and fear. I respect the markets, okay, and I fear myself in unsure conditions. I don't fear the market. I fear myself in unclear conditions. So if I can't see with any measure of visibility in price action, what business do I have taking on risk? How am I going to measure if what I'm looking at is working or not? Just because it gave me money or it was a loss? Either one of those scenarios is a mistake. I shouldn't have gotten in the marketplace to lose that money. And if I do make the money on the move, it's pure and utter luck. And that's the only time I think luck exists, okay, when you got something that you didn't really earn. So you see clearly on this chart, I have the draw and liquidity. Now, these are all very, very central tenets to month one, okay, that content. So I'm amplifying some of those things here because we're going to now bring in the importance of the daily high and the low. So if we look at the daily high and low on the 12th of June, okay, I've measured the daily high and low with a fib. I've just basically highlighted the 50 level, and I'm annotating it with equilibrium of the daily range. Now, what that means is it's the equilibrium of the 12th of June, 2019. So that price level is what we're looking at. High probability fair value gaps when the market is bearish. In this case, like I mentioned on Wednesday, that we would most likely see Aussie dollar probe its 68.65 level on the daily chart. So it gave you directional bias. It gave us a draw on liquidity. The most important factor had already been determined, which is where is it reaching for? Not show me how to get in, Michael. Tell me how to buy and sell it, Michael. Tell me when you're going to buy the cable, Michael. Okay, I get all these emails all the time. It's not when I'm going to do something. It's when you should do something. Okay, and by studying, you're learning how to do that. So how do we take this one step further when we know that there's a strong one-sided directional bias on a market, whether it be your pet pair or in this case, like we saw on Wednesday, I rung in Aussie dollar. Now, do I often talk about Aussie dollar? No. Why did I do it Wednesday? Because it made sense to do so. I admitted that I was divided on my thoughts about both the Aussie, I was divided on my thoughts on the dollar index, the euro dollar, and the cable. Well, that's my complete triad. So I'm dead in the water, right? What do I do? I do nothing and make you all restless because, hey, I'm ICT. I should do something. I should know something. So I'm using my experience, and I pointed out Aussie dollar had the low resistance liquidity run set up that you learn about in month 1 content, just being applied to a daily chart. That was the market to be paying attention to. It had the clearest directional bias to it. It was clear to see what they were reaching for, so therefore, there you go. Now, there's 2 schools of thought with that. You could have said, okay, well, if you're bearish Aussie dollar, wouldn't that imply that the dollar could be bullish and therefore roll over in terms of sympathy? Euro dollar and cable should go lower too. And that could be one argument where you could say, okay, that it may be true, but it's not always. I don't want to sell that idea to you because it's not always the case. Okay, and I want you to focus on the markets that are really primed to move, and that's all I was highlighting on Wednesday. That was the only market that I felt confident in picking a directional bias and a target. Notice that I shared no real insights that were of any benefit to you for euro and cable and the dollar. I was honest with you. I told you what I felt. I felt that if certain scenarios would happen, what they would imply for my thinking and my thought process going forward. And that's about it. That's all you would do in your own real world example, in your own experiences. But you have to consider, and again, if you're not going to do simply nothing and be patient, then you look at other markets, and they may provide you a means of looking at the market with an opportunity then, like we did with the Aussie dollar on Wednesday. So with that said, what makes high probability fair value gaps and where do they form? When we're bearish, and everything I'm saying here, you just reverse it when it's bullish, but we've split the daily range on the 12th of June. The equilibrium of the daily range is this level right here, okay? So this range to the daily low, that is your sweet spot, if you will. You want to be seeing a fair value gap form in the lower half of the previous day's range. That's what's showing here, okay? So now, why is that important? IPTA will not want to go back above the previous day's midpoint, okay, or equilibrium, once price sweeps below the low, like it does on the 13th. Price drives aggressively down like that. It should never, ever, ever come back up to equilibrium. Okay, if it does, that's really implying that there may be a deeper retracement required or an outright reversal. When we have a fair value gap form in the previous day's low to the equilibrium, as we see right here, we have a fair value gap inside of the range between the equilibrium of the previous day's range, which is this low, to the midpoint up to that high. So on the 13th of June, which starts here, the market does what? During Asia, which is a sweet spot for Aussie dollar, okay, so that's like the really, really nice responsive time for Aussie, New Zealand, and yen pairs. So this is all really applicable to all pairs, but when we're talking about Asian session, those three are specific. So we have a fair value gap. We want to see price run above this up close candle's high. That's all that's necessary, okay? But we do get consequent encroachment, which is the midpoint of the gap. Price dries up during Asia. That's your Judas swing. Right there, that's the moment when you would be looking to go short. And why? Because it's in the lower portion of the previous day's range, the lower half of it. Price will not want to go back up to that. I mentioned that if we go below this daily low, it should never want to go back above that. That's why you want to keep your stop there until you take first profit. Okay, so in other words, if you take a short here, the stop has to remain there, or above it rather, before you take first profit. And then you can start mitigating some of that risk from your stop loss and trailing a little bit closer. Not jamming it up to break even, not jamming it up to plus 20 or 10. You just want to start reducing it. Keep it away from the markets. That way you're managing what the market's doing right now and keeping your focus on what it may still be reaching for, which is down here. Okay. So if you jam the stop from above here, right below this low, you could really get tagged out, because this retracement here could have came back and hit the daily low, the previous day's low. It can do that. That's your standard support broken becomes resistance theory. Okay. In this model, I want you to think, whenever we have a fair value gap and it's inside of the lower portion of the daily range of the previous day, okay, in other words, like yesterday's daily range, if we divide that in half, in the lower half, when we're bearish, if there's a fair value gap that's formed, that's a high probability, especially if we know there's a draw on liquidity lower than we're at now, as outlined on Wednesday's commentary. Now, I want you to look at euro dollar and cable, because this actually formed in those pairs too, but it was at a time when I was unavailable to be able to point it out to you, and I'm not sharing anything on Twitter anymore. So I did engage with the Aussie dollar last week on these examples, and I want you to know that it's not important me showing you the trade results, because admittedly they were very large trades, and I'm not here to try to sell you on the idea that you have to have a six-figure trade. Okay, it's not important. But the fair value gap and defining it for high probability, this is what it looks like. It's going to be in the lower 50% of the previous daily range when bearish. If that happens, then you know that you have a high probability fair value gap, and it occurs during a kill zone, which is the Asian kill zone. Okay. Now, if we know that is the rules, same thing applies here on Friday. We have previous day on Thursday, the daily low, the daily high. Let's split that range in half. Then we have equilibrium of the daily range, previous daily range. So from this point here down to the low, if a fair value gap forms and we're bearish and we have not traded to the draw on liquidity yet, if price trades up into it, here's the fair value gap, and here's London. It trades up into it. It does what? It goes right above the equal highs. Doesn't need to go much above it. That's all you use, the order flow entry drill. That entry gets you short for a run to the draw on liquidity. There's your fair value gap. This is the range that you have to look for the fair value gap to form. Look over here, you can see it right there. Okay? So inside of the range of the previous day, splitting that range to the low, that can form a fair value gap inside of the previous day, or it could exist or be formed in the new day like it does here on the 14th. That's your caveat, okay? Don't think that the fair value gap has to form in the previous day, because it's not required. It does not have limitations in terms of time to that degree. It will look for the imbalance, but it's going to frame it based on these factors, okay? So I've given you a huge element of some of the things I'm going to talk about in 2020. They're algorithmic in nature. So why certain things are being seen in price action and they repeat themselves over and over and over again, it's based on the fact that IPTA will do these certain things because the arrays that it's using to frame certain ranges, they're there, but they've always been there, but you're not seeing them, and you don't know how to build a context around them, and that's what I've shared with you tonight. Looking at it on a 4-hour chart, you can see those are the fair value gaps, and you can clearly see if you wanted to be a larger trader, you can see it exists here. And then obviously the daily, we mentioned on Wednesday that we would see these lows be taken out and probed. And then we see power 3 on Thursday, open, rally, Judah swing, down, close, open, rally, Judah swing, down, close. Both of the Judah swings in here were basically fair value gaps to be used for shorting purposes going into that 68, 65 liquidity pool on a daily chart. So in closing, I've given you a huge wealth building insight. Again, like I've said in the past, don't talk about this stuff on social media. Okay, don't share it with other people, because I'm seeing a lot of my things be tossed around like they're just completely, it cost nothing for me to acquire it. It cost a lot. So I'm really apprehensive to teach the real high-end stuff because there's a lot of people in here that just want to be rock stars on social media, okay? Or they want to go on Facebook and pretend they understand IPTA. And none of you understand IPTA. None of you. You just have a couple things that I've shared so far, but you don't really know it yet. And these yahoos that are on the internet, okay, because they got copies of a guy that I got, removed from the mentorship, his copies are going all over the place, and they're just the copies of the lessons on each month at the top of the page. But these are the real lessons. The mentorship is the ongoing secrets. That's the stuff that is being taught to you on a week-by-week basis. So I want you to respect what I'm sharing, because I'm not seeing a lot of that on social media. I'm seeing a lot of the opposite of that. So if you want me to clam up, okay, and be reluctant to teach the really, really high-end stuff, you got to be more respectful with it. When you send me tweets, you're saying, hey, ICT, what about this and what about that? And you're actually sharing screenshots of my videos. And your questions may be sincere, but you're also sharing and teaching indirectly. So I know that's another reason why I'm off of Twitter now. I don't want people to be able to reach out to me in front of everyone else and ask me questions that are mentorship related. So you either send them to me in an email or you post it on the forum. I get to it eventually, and then I give some response in a video, because I can't respond to everyone, point by point. It's just too many of you. So that's going to be it for this lesson. Obviously, there's a lot more to talk about with fair value gaps, and we know there's other PD arrays that we have to cover. So that's what I'm saying. There's so much content and so many things that you need to learn, but you have to do it in bite-sized pieces and then study it, look at it, and you'll start over a period of time, start drawing parallels to certain things, and they will come together. All the ICT concepts will dovetail nicely over time. But right now, they feel disjointed, they feel fragmented, they feel like I don't know when certain things are supposed to be used. Well, you have no excuse for when to expect a fair value gap, because now you know exactly when they're going to form, in the form of a fair value gap that's in a high probability, not just a simple gap. Fair value gaps that exist in the previous day's range when bearish, the lower half. Now, if we're bullish, we're going to be using the previous day's range, dividing that in half, the equilibrium, to the previous day's high. That's where the bullish fair value gap is going to form when it's a high probability and it's a kill zone. Okay, so when you have those elements, it's a locked, loaded, it's so one-sided and in your favor. Those are really good times to trade. Now, contrast that with all of the times where you practice with your demo account and they didn't pan out. You may have thought you saw a fair value gap, okay, or maybe there was a fair value gap and it just was a losing trade. If you look at price action, very rarely, okay, it's so rare that a fair value gap trade, when you have a draw on liquidity outlined beforehand, they rarely ever fail. Now think about that. Now, I don't think you've really put any thought behind all of that, what I just said, but when you see a fair value gap form in price action and it trades into the order flow entry price point minimum, okay, or goes to consequent encroachment or fills entirely, if you use the low-hanging fruit entry, which is the order flow entry technique, if you're using that, it's assuring yourself that you're going to get in the trade. Now, some of you may want a higher, tighter entry for shorts, okay, or a very low discount entry for longs and fair value gaps. When you do that, you're opening up yourself to missing the trade. So I don't demand that much of precision on my entries because it's the least of the important factors. Knowing where the market's reaching for, that draw on liquidity, that's where all your homework and your time is supposed to be invested. I've given you dozens of ways to enter the trades, and you only need one. But you may not get a fair value gap. You may get an order block, or you may get a mitigation block, or you may get a breaker. Okay? So just know that we're graduating through each one of the PD arrays, and we'll be doing things like this on all of them. You think you know order blocks, and you don't know order blocks at all. There's so many things that we're going to be teaching with that as well, but you can see that we're mining fair value gaps pretty deep, and we haven't even really scratched the surface yet on this PD array. So again, I'm counseling you to go through your charts and look at the framework what I just gave you here. And I'm telling you, you're going to have a hard time sleeping, okay? Because it's been there all this time, and once you see it and you understand what it is that is outlined here, it's gold. It's absolutely a Midas card, because if you understand this, you will never be without a method to find setups. You just simply wait for them to form. And you won't be unsure, you won't be confused, you won't doubt. You'll know exactly what you're doing. That's why I'm confident. It comes across as arrogant, but it's confidence, because I know what I'm seeing is going to pan out. Now that sounds unheard of in technical analysis. What are you talking about? How do you know? Because I get that question all the time. How do you know this order block's going to hold? How do you know this breaker's going to do this? And how are you going to? Ultimately, I really don't know. But my faith in the characteristics, like I just showed you here for fair value gap, look at the price action. Study. I don't care what you trade. Go back through all of the data you can find on it. And it has a 98% strike rate. Think about that. That's insane. That's insane. Where are you going to go and get those kind of odds? Think about it. That's just one PD array I've outlined for you. Just one. We have a whole lot more to go. And we have so much more to mine in the fair value gap. So hopefully you found this insightful and inspiring, and get to work. Go back through your charts. Study, study, study. And I'll talk with you guys next week in the midweek update on the ICT mentorship.